My name is Brian Shannon. You might have seen my work online on alphatrends.net or perhaps the book that I wrote, Technical Analysis Using Multiple Timeframes. What I want to do today is take you through a quick tutorial on understanding market structure. What we have here is this infographic. You can kind of look at it as a cheat sheet for understanding market structure, because what we have here is kind of the whole way that you want to use the alpha scanner to find stock ideas each day. Now, there's 4 different stages that the market can be in, one of 4 different stages. The stage 1 accumulation, stage 2 markup, stage 3 distribution, or the stage 4 decline. What we want to focus on as trend traders, at least, is the stage 2 uptrend and the stage 4 decline. What we want to do, obviously, is be long the stocks that are rising and be either out of the ones that are declining, or if you're a short seller, those make good candidates for establishing short positions when we have a downtrending market. The stage 3 distribution, stage 1 accumulation, I generally look at them as kind of a waste of time. They're stocks that have either gotten beaten up and they're just starting to recover, the process of buyers slowly regaining that control before the stock enters the stage 2 uptrend. Now you can see here we have these stages all broken down into 3 different sub-stages. What you can do with the alpha scanner is you can look for stocks in any one of these 12 segments, time segments that is, or stages of the cycle, using 3 different time frames simultaneously. You could be scanning for just weekly trends, just daily trends, or just intraday trends. Or you can combine them and say, you know, show me the stocks that are in a stage 2 uptrend on the weekly time frame and the daily time frame. But maybe what you want to look for on the short-term time frame is the stocks that have experienced a pullback recently. So you'll be looking at it such as this. What we'll be looking at is we'll be taking this uptrending area and kind of expanding it onto a shorter-term time frame, which is what this is meant to be. So when we have a primary stage 2 uptrend, we want to look at our shorter-term time frames and look in there for our action points. So if we're looking, for instance, if this was a daily time frame, just imagine that this might be the S&P 500 for a year or so. Well, the stock market might go sideways as it begins to rally. That's when we want to buy it. But of course, we don't want to buy it after a big move has been made. We want to ask ourselves 2 questions. Where does the market come from? And where does it have the potential to go before it's likely to run out of steam or encounter some resistance? Now, where it's come from, the stock may have already exhausted itself and is in need of recovery. So what we want to do is we want to look for those little areas. We don't want to buy the pullbacks in here. What we want to do instead is we want to kind of avoid those pullbacks and then wait for the stock to kind of turn sideways on that shorter-term time frame. As it turns sideways and begins to accumulate, well, the short-term pattern of lower highs and lower lows is no longer existent. So we want to start stocking that trade in there. We want to anticipate. This is where we're going to come up with our risk-reward ratio. We want to start to say, where do I set a stop for a long position? And where's my long trigger? Where's my trigger to get long? How much risk am I willing to accept? And how much potential reward do I see before the stock is likely to encounter some resistance? So we want to anticipate and do our planning in part A, basically. In part B, what we want to do, that's where we want to participate. That's where we want to buy that stock as it makes that short-term higher high. Set our stop underneath the higher low, and then participate in that rally, that stage 2 rally on the short-term time frame, which is now aligned with the stage 2 daily time frame. Once the stock starts to distribute on the short-term time frame, you have to remember, again, that stocks are going to correct one of 2 ways. They're either going to correct sideways through time, where they undergo distribution, or they're going to turn lower price-wise. Well, either way, that's not the type of stock that I want to be involved in. As the stock starts to turn sideways after a rally, you want to lock in your profits, raise your stops up, and if the stock begins to decline again, well, that's the part you avoid, and you don't want to get involved, obviously, because your risk there is price. The risk during the accumulation is time. So there's the risk of time and price. And in the market, things move so quickly, if you're not right on top of all those, if you're not trying to build a huge position in that accumulation stage, that's the time to just sit back and wait, watch, stock your trade, basically. On the flip flip side, if you think about the stage 4 decline, what we have in here is obviously lower highs and lower lows. We have declining moving averages. We have rallies that fail often just short of those declining moving averages, or sometimes they'll come up through the 50-day moving average, but the 50-day moving average is declining. If that's the case, be really highly suspicious of those rallies. So what we want to do instead, we obviously want to participate when the stock's getting hit hard. As it accumulates, that's when we want to cover our short position. So the bulk of the short-term drop has occurred. The stock starts to turn sideways, and that's when we want to take our profits. We want to lock in our gains and realize the rewards of the risk that we took. So as it accumulates, we want to, again, get out of our position. We want to exit it. As the stock begins to rally in a short term, let's just think of this as one of these short-term rallies within the primary downtrend. Well, as it rallies, we want to avoid that stock. You could, of course, make money trading the long side in a declining stock. However, if you think about just the mathematical definition, lower highs and lower lows, there's always going to be more opportunity on the short side in a downtrend than there is in the long side bounces, because the sum of the declines, drops 3 points, rallies 2 points. Drops 2 points, rallies $1.80. But the sum of the declines will be greater than the sum of the rallies. Otherwise, there's no longer a downtrend intact, and there's no reason to be short. But back to this, what we want to do is then, in our anticipatory analysis begins in this short-term stage 3. So after the stock has rallied, we're going to avoid those rallies, and we're going to instead stalk the trade. Once that stock kind of rallies up, it has those higher highs and higher lows, begins to distribute, turn sideways on the shorter-term time frame, that's where we want to start to plan, okay, here's where I'm going to sell it short. As it breaks down, make a lower low. I'm going to set my stop up just above that most recent lower high. Because if it reverses up through that lower high, well, the definition of our downtrend is no longer intact. We now have a higher high, and obviously we don't want to be short if the stock's making a higher high. So we want to anticipate in here, as the stock begins to drop, and you start to see maybe a little bit of fear just starting to come into it, you'll see that that's where we want to participate. That's where we want to sell short, have our stop in place, and ride it down and repeat that cycle over and over again within the primary trend. So let's take a look at the whiteboard and see how this might look